Hi, my name's Reeve. I've been an employee benefit specialist for over 35 years, and this video is designed to give you a quick overview of some basic insurance terms. Now, it's important to note, as a caveat, that I am not an attorney or a CPA. I don't even play one on daytime TV. So if you need tax advice or legal advice, please contact one of those professionals. One of the most confusing parts about insurance is copays, deductibles, and coinsurance. So let's take a look at them. A copay is the amount you'll pay for a specific service, a doctor's visit, a prescription. And normally that's all you're going to pay for that service. If you have multiple services or a doctor's visit with a procedure, you may pay another copay or you may pay part of your deductible. Copays don't get credited towards your deductible, but they do count towards your maximum amount of pocket, which we'll discuss in a moment. The deductible is the amount you have to pay before the insurance company pays anything. Coinsurance, after you've met your deductible, is how much the insurance company will pay. So typical plans are 80-20 or 70-30, some are even 50-50. This means that if it's an 80-20 plan, the insurance company is going to pay 80% of the amount of the bill, and you're going to pay 20%. And that is based on the contracted rates that those providers have with that insurance company. Once you have paid your coinsurance, you'll probably be close to your maximum out of pocket. The maximum out of pocket was established by Obamacare and is the maximum amount that you can pay in any given year. Now that includes doctor's copays, prescriptions, hospitalization, deductibles, coinsurance. Once you've met your maximum out of pocket, you're done for the year. Another big issue is in and out of network. Most plans nowadays don't provide out of network coverage at all. And that's a big change over the last 4 years that Obamacare has brought to us. So in-network means you're using the doctors that have contracted with that plan. Please, I urge you not to make any assumptions. If your doctor sends you to a lab or an x-ray or a specialist, make sure that that provider is in the network, or you may pay a lot of money out of your pocket. Pharmacy networks also have participating and preferred lists. So you want to make sure that you're getting the best deal you can, even sometimes if that means changing pharmacy to one of their preferred networks. It is your responsibility and no one else's to make sure that you are in the network. Out-of-network coverage, if it's available on your plan, means that you're going to pay a higher deductible and more coinsurance and more out of pocket in order to use doctors that are not in the plan. Again, most networks don't provide out-of-network coverage, and that means if you go out of network, you'll pay everything. So please be careful on this. So let's look at an example. You have a $1,000 deductible, and then the plan pays 80% until you hit a stop loss of $5,000. What does that really mean? Simply, it means you're going to pay the first $1,000. Then the insurance company will start paying 80% and you'll pay 20 until the amount of claims hits another $5,000. So in English, that means for the next 5 grand, you're going to pay 1,000 and the insurance company is going to pay 4,000. After that, the plan will then pay 100%. Another thing to be aware of is, how does your plan's contract work? Are you a calendar year or a contract year plan? Most plans are calendar year, January 1st to December 31st, but your plan might be based on your contract year. You're renewed in July, and so everything runs to July. That's important because that's when your deductible ends, your coinsurance ends. It's when your maximum out-of-pocket resets. So if you have a couple of big claims in October and you've just met your deductible and you're on a calendar year plan, that means January 1st, you'll have to meet your deductible all over again. A quick word about a couple of government programs, because sometimes the terms get interchanged. Medicare are for those over age 65 or those that have been permanently disabled and are under age 65. and it is funded by a Medicare tax paid by employees and employers. Medicaid, on the other hand, covers low-income individuals and those people that cannot afford commercial insurance or Medicare.